Hi, good morning, everyone. Thanks for joining us for our weekly morning call. We have quite a few stock counter updates, the Airbnb initiation, as well as a few Phillip on the ground. And we also have a recap of our third quarter 22 US strategy, as well as the Singapore strategy, and the usual Singapore weekly. So without further ado, I will hand it over to Ambridge to start off with Airbnb.
Thank you, Glenn, and good morning, everyone. So last week we initiated coverage on Airbnb and the report was titled Rising Above Pre-Pandemic Levels. Next slide, please. So Airbnb is an online marketplace and it connects hosts to the travelers. It allows the travelers' guests to book unique places for accommodation as well as it can provide experiences, which includes cooking or meditation classes. Airbnb offers 6 million as active listings from over 4 million hosts spread across 220 countries. Last year in FY21, Airbnb's revenue, they grew by about 77% year on year to about $6 billion US. And this was mainly because the travel demand rebounded. 53% of the total revenue was generated in the US, 32% from Europe, Middle East, and Africa, and 7% each from Latin America and Asia Pacific. We expect Airbnb to report a maiden net profit of about 1.4 billion US dollars in FY22, and this is compared to 352 million net loss previous year in FY21. This is mainly because its bookings volume at Airbnb have risen steeply. Lastly, Airbnb does not own any of the properties it lists on its platform. It just earns a commission as a percentage of the transactions that have been booked on its platform. This is, as a result, its business model is asset light as it does not invest in any fixed properties. And this helps to increase its profits as well as to generate a free cash flow. Previous year, it generated a free cash flow of about 2.2 billion US dollars. Next slide, please. So moving to our investment thesis, the first one is Airbnb is witnessing a surge in its booking volumes. It is recovering faster from the pandemic-driven drop as travel restrictions, they continue to ease worldwide. On the right-hand side chart, top chart, it's a number of nights and experiences that have been booked on Airbnb's platform. Last year in FY21, the bookings volume, they grew by almost 50% to about 300 million nights. This was just an 8% drop from its pre-pandemic levels, that is FY19. Meanwhile, its peers, Bookings and Expedia, they are still working their way to reach their pre-pandemic levels. The volumes at Booking and Expedia, they were down from their pre-pandemic levels in previous year by as much as about 30 to 40%. So we expect the number of room nights and experiences booked to accelerate in the current year FY22 in the near term as the travel has been rebounding. So Airbnb, we estimate its nights to be booked to reach almost about 400 million, which is like surpassing its FY19 levels by about 28 to 30%. So Airbnb's outperformance is mainly because it is the leader in short-term rental market. It has a unique supply base, as well as there have been an increased spending on alternative accommodations. Secondly, there has been a pent-up demand for travel, which is leading to rising prices or average daily rates. In FY21 gross bookings value, it nearly doubled to 46.9 billion US dollars, surpassing its FY19 levels by about 20%. So the gross bookings value, this is basically the dollar value of bookings that have been made on its platform in a particular period. This growth is mainly driven by strong bookings volume and higher average daily rate. And the average daily rate, it was about 156 US dollars in FY21. So the main reason that the average daily rate has been rising, it's mainly because of the price appreciation and business mix shift towards bookings in North America. So we additionally estimate that the revenue would grow by about 38% in FY22 year on year. And this is mainly because of boom in travel, both urban and cross-border. as well as there could be a growth in longer term stays, which company stays that more than 28 days. The growth would be visible over there. This is mainly because the shift of remote work as it accelerates. Next slide, please. So our third investment thesis on Airbnb is that it differentiates itself from its competition by constantly releasing product upgrades and adding new features. In last year in FY21, the company released over 150 upgrades to its platform, and they include like air cover as well as flexible date search tools for guests. Last year, the company, they spent about 24% of its revenues on product development. We estimate that its peers Booking and Expedia, they spend in the range of 4% to 12%. On the right-hand side chart, in FY20, the product development expense, it was significantly higher to almost about 80%, mainly because of its IPO. So overall, we believe that product innovation, it improves the user experience, as well as it leads to higher retention of Airbnb guests and hosts. Moving on to risk, we first of all, Airbnb, it faces risks from macro factors. So high inflation or recession, it may hurt travelers' budget and their traveling plans. Also, a surge in COVID-19 cases, it could impact the overall travel demand. Secondly, Airbnb's platform, it is facing increasing competition from various online travel agencies like Expedia's Vrbo bookings. And lastly, any unpleasant behavior by guest or host, it might hurt Airbnb's brand image. Next slide, please. In terms of valuation, we have a target price of $119 on Airbnb, and this is based on DCF valuation. We have used a 6.8% weighted average cost of capital and 4% terminal growth rate. So overall, we believe that the pent-up travel demand has been, and as the lifting of COVID-19 related restrictions, they offer strong tailwinds to Airbnb in the near term. I would now like to pass on to Jonathan for our review of our equity strategy for third quarter 2022. Thank you.
Thanks, Ambrish. Good morning, everyone. So I'll just be sharing a short snippet of what we shared on Saturday during our third quarter strategy. For the full video, you can hit the YouTube to check it out, our PhillipCapital YouTube channel. So for the FAANGMs, right now we see that valuations are actually relatively low. When you look at this chart, FAANGMs are the forward PE valuation is about 27 times, which is slightly below its 10-year average of 31.4 times. Interestingly enough, it's actually below the pandemic lows, which were at 29 times. So we feel that this kind of suggests that the pandemic-induced hype and overvaluation has subsided significantly. We believe that fundamentals are going to start playing a bit of more of a key role right now. Most of their secular tailwinds remain intact as well. So, for example, streaming is gaining market share as compared to TV and overall entertainment. Digital advertising is also continuing to increase. Digital ad spend is continuing to increase. And also, the bar is set super low for the second quarter 22 earnings, which is coming up towards the end of this month. So we think that any outperformance should really drive these quality stocks upward. Next slide, please. So I'll just run through the counters one by one. So for Meta Platforms, one of the key merits that they have, and one of their strong suits, is that they have a really strong network effect. So people are less likely to leave the platform to go to another platform. This is something that digital advertisers or marketers look at, because at the end of the day, they look at how many users you can attract on your platform. So daily active users and monthly active users are really strong metrics and very important metrics for Meta. Currently, they're trading at really low valuations, historically low. I believe it is at about 12 times, around 12 times forward PE, well below its 10-year average of 33 times, and also below the overall Nasdaq's average of 21 times. In terms of some headwinds, we still see Apple's privacy changes continue to affect Meta's business model. So if you didn't know, Apple actually changed their or they introduced a new privacy setting in their iOS 14 update last year, which allows users to essentially stop sharing its data, stop giving its data to other third-party apps like Google or Meta, Facebook. And what this has done is that it's made it a lot more difficult for Facebook, specifically to increase the effectiveness of its targeted ads campaigns, because there's a lot less data that they receive right now. So one of the challenges that they are facing is that they have to be able to continue being effective in terms of targeting ads using way less data. One of the second negatives, or rather second headwinds that we are seeing for at least the rest of this year, is that the company is increasing a lot of its expenses, largely due to tougher competition from other advertising companies and social media companies like TikTok, especially as the company tries to transition into a more short-form video-heavy platform. So we still maintain a buy on Meta with a target price of $231 US. Next slide, please. Okay, so for Apple, we think that they're still going to continue to be a beneficiary of the 5G replacement cycle, especially as there still are a lot of upgraders that have to switch, or that will switch from their 4G devices. But we do think that one of the key drivers for earnings will come from its higher margin services, and these include like your App Store fees, Apple TV subscriptions, and stuff like that. We think that this will definitely be a driver, because we can see that over the last couple of quarters, services have been growing at about a 20% year-on-year increase, and it's been like that for the last couple of years. And we think that with overall revenue growth largely in the 5 to 10% range, just because it's mainly hardware, we think that services, and especially the higher margin services, will be able to increase overall margin and boost earnings. We also see that so far Apple has been able to pass down most of its cost to its customers. So they raise their product prices every year or every new launch, and while they do this, they've still been able to maintain a lot of their unit sales, showing strong pricing power. One of the short-term headwinds that we see is that we think that weakening consumer demand may affect product sales, especially as consumers start shifting away from purchasing durable goods like furniture and home electronics, and into more travel-oriented service kind of spending. So we still maintain a buy on Apple with a target price of $194 US. Next slide, please. Okay, so moving on to Amazon, we think that Amazon will continue to be a beneficiary of increasing cloud adoption, especially with the dominance of Amazon Web Services in the cloud industry. We expect its e-commerce monopoly in North America to continue, at least for the foreseeable future. We don't think that there will be any real other e-commerce players that could challenge them in that particular region. They are trading, or Amazon is trading at relatively low levels compared to its historicals, at about, I believe, 60 times for PE, which is really high compared to the Nasdaq average. But I guess it's a premium that investors don't mind paying just because of this monopoly. One negative effect that we see in the short to medium term at least, would be the fact that it has to deal with a lot of overcapacity and overstaffing issues brought on by the pandemic. Just because due to the pandemic, there was a lot of buying, there was a lot of demand for durable goods. So the company had to hire a lot more staff to deal with it, and also they had to build a lot more warehouses to house all the inventory. So one of the things that we can see moving forward is that they'll either start selling their inventory at lower margins, so they'll put it on sale, and they probably also have to start laying off some staff to reduce costs, at least for the rest of this year. So we still maintain a buy with a target price of 133 US dollars. Moving on to Netflix, we think that Netflix still has relatively strong pricing power, so they've been able to increase prices in some regions without losing users on an overall basis. They remain the market leader in streaming services, producing billions of dollars worth of content each year, even amidst tough competition from other players like Disney Plus, Hulu, Amazon Prime. Currently, we think that they're heavily undervalued. They're trading at about 16 times forward PE, well below the Nasdaq's average of 21 times, and well below its 10-year average of about 110 times. One of the kind of near-term headwinds we are seeing right now is that there's some issues with revenue loss from password sharing. So over their first quarter 2022 earnings call, they mentioned that about half of their subscribers are actually sharing passwords outside of their household, which is quite a significant revenue leakage over there. Also, they're seeing user growth stagnate in some developing regions like North America and Europe. And one of the reasons for this is A, the password sharing, and B, they're just not that, it is already so saturated in these areas, which is one of the reasons why the company is actually looking towards other regions like Asia Pacific region to drive further growth. We maintain a buy on Netflix with a target price of 399 US dollars. So moving on to the last counter for me, before I hand it off to Ambrish, will be Alphabet. So we see that Alphabet remains the dominant power in digital advertising. They've got more than 50% market share, and their ad revenue is growing has been growing at a 22% 5-year compound annual growth rate. So growing really quickly. We think that Alphabet is still also, or rather, they remain the monopoly powers in many of their product segments. Many of their verticals like mobile OS, their Android system, as well as digital maps like Google Maps, and as well as other things. We think that in terms of valuations, they're well below their 10-year average of these 22 times. Right now, they're currently trading at about 17 times forward P. We maintain a buy with a target price of 2,879 US dollars. Do take note that after today, this will basically be divided by 20 because they announced that they will have a stock split, which should take effect when market opens this evening. So that's all for the FAANGs. I'll pass my time on back to Ambrish to cover Microsoft. Thank you.
Thank you, John. So for Microsoft, we still like it, and there are two main reasons. Its growth drivers are the productivity software and cloud Azure, and the number of users and pricing for both of them has been rising. Microsoft has about 90% market share in the global productivity software, which mainly includes its softwares like Word, Excel, Outlook, Teams. And the key growth drivers for this productivity segment would be the economy reopening, as well as there has been increasing need to manage tasks and workflows. So as offices reopen and employees start going physically to office, we believe that the Amazon's productivity software demand would rise as more people might have to use its productivity tools like my Office 365. So Azure, moving to Azure, it's the Microsoft's cloud service, and it is the second largest global public cloud provider with a market share of about 20%. We believe that the demand for Azure will continue to grow as the companies, they digitize their operations and they move to cloud, mainly to remain competitive. Also, additionally, the other thing is Microsoft's cloud sales are high margin business. And as a result, any growth in Azure's top line growth, it would also help the company's profitability to grow. So the third growth driver for Microsoft is that its cybersecurity attacks have been rising, mainly because of Russia-Ukraine war. And as a result, we believe that the companies, they will upgrade to higher end licenses for better improved security. So overall, we believe that Microsoft is trading at attractive valuations and remain optimistic on its future, mainly because it has earnings visibility. Also, it is less targeted by federal regulators and it has a less impact by inflation since it is a software. So overall, we have a target price of 338 US dollars on Microsoft. So I would now like to pass on to Glenn for Singapore strategy. Thank you.
Thanks, Ambrish. So we'll be covering a few of our stock picks from the third quarter Singapore strategy. So just looking at our absolute 10 portfolio, but we have changed it just a little bit. So we have removed Fraser Centrepoint Trust and included Singtel. So I'll move on to OCBC. So OCBC, just two quick recaps from their first quarter results. Firstly, was that their net interest income grew 4% year on year. So their net interest income grew also by 1% quarter on quarter. And this was mainly led by loans growth of 8% year on year and 1% quarter on quarter. So however, their NIMs, their net interest margin, declined by 1 basis point year on year, but it grew 3 basis points quarter on quarter to 1.55%. And their loans growth was mainly driven by Singapore, UK, Australia, and the US markets. For their loans growth guidance, OCBC has guided for mid to high single digit for the rest of the year. So secondly, their allowances fell by 73% year on year to 44 million. So in the fourth quarter, the allowances were pretty high and it fell by 86% quarter on quarter to 44 million. And GPs of general provisions of 13 million and specific provisions of 31 million were made during the quarter. And their credit costs also improved by 31 basis points to 6 basis points, and this is due to the improving credit environment. So now moving on to the outlook, as mentioned earlier, you can see that the loans growth grew 8% in the first quarter, and this is meeting the bank's guidance of a mid to high single digit increase for FY22. The management sees further lending opportunities in the wholesale segment as well as their sustainable financing. The mortgage pipelines in Singapore and Hong Kong are also healthy, with more drawdowns expected in FY22. For the NIMs, the management has guided for stable NIMs of 1.5 to 1.55% for FY22. However, it has said that based on historical data, a 100 basis points increase in rates would lead to a 18 basis points increase in their NIMs. So if you see from this chart here, you can see that we expect the NIMs to improve in FY22 as well as 2023. And this will also ultimately affect their net interest income, and this would increase as well. And it will also benefit their bottom line. So we prefer OCBC due to its upside of 26% to our target price of $14.22. Furthermore, OCBC is currently still trading the cheapest amongst the three local banks. OCBC will also be a beneficiary of the rising interest rates with a CASA ratio of 63%. And this is higher than UOB's CASA ratio of 56% and comparable to DBS's CASA ratio of 68%. There's also potential for higher dividends from OCBC due to its higher CET1 ratio of 15.2%. And this CET1 ratio is the highest amongst the three local banks. UOB's CET1 ratio is at 13.1% and DBS's CET1 ratio is at 14%. So that's all I have for OCBC. I'll now hand the time over to Terence.
Yeah, thanks, Glenn. So for Capital Corporation, for us, the main re-rating catalyst will be the successful divestment of its O&M business, Asset Co and Logistics business. Sorry, just one moment. So we say the re-rate for Capital Corporation, the re-rating catalyst. Oh, sorry, just give me one. For Capital Corporation, the re-rating catalyst is the successful divestment of O&M business, because this is still not yet approved. So they still need to get regulatory approvals, and then they still need to get EGM approval from their shareholders before this can be successfully divested. So until this is divested, we think Capital will remain will continue to trade in a tight range until they receive this catalyst. But we have here the pro forma EPS impact of the combination, assuming the deal was done and completed in 2021, the earnings per share would be 72.5 cents. So it's this graph here on your right hand side, instead of 56 cents on the left hand side. So we have a buy rating on Capital with a target price of $7.07. In our next slide, for city developments, we see two main catalysts for city developments. Firstly, we continue to believe that the supply crunch in Singapore will continue to support the property boom. So if you look at the table, these charts here on your left-hand side, you can look at the number of residential units sold in Singapore for FY19 through to FY21. You can see that in FY21, we see a huge spike from FY19 and 2020. CDL moved 2,185 units. Which is significantly higher than the 1,318 units in FY 2020 and 1,554 units in FY19. In terms of sales value, this is also significantly higher at $4.3 billion versus the $1.9 billion in FY 2020. We can see that the property demand continues to remain robust. We see for the first half of 2022, one of their new launches, Piccadilly Grand, the property was actually 77% sold, and this was done at an average $2,150 PSF. And Piccadilly Grand is actually an OCR at the OCR region, which really supports the kind of demand that the mass market have for such properties. For the second half of 2022, they're set to launch Tengah Garden Walk with an estimated 408 units and the residential component of Fuji Xerox Towers redevelopment. So Fuji Xerox Towers redevelopment will benefit from the CBD redevelopment scheme, where they can top up the GFA. So we expect this to actually have a good uplift for their overall margins when it's launched. In my last slide on CDL, the hospitality segment is also expected to rebound strongly. CDL has a total of 14,000 units, hotel rooms all around the world, and they are set to benefit from the recovery in the hospitality sector. So if you look at some of their key markets in Singapore, London, and New York, this was up very, very strongly in the first quarter of 2022. But for the only laggard was Australasia, which was down 12.5% for RevPAR, and this was because of the resurgence of Omicron. But having said that, we do expect the hospitality segment to be a strong driver of its earnings for the rest of 2022. So we maintain our buy rating with a target price of $9.19. So that's all from me for city developments. I'll now hand over the time to Paul.
Thanks, Terence. So I'll move on to Ascott Residence Trust. So for us, we still think that Ascott is still in the early stages of a recovery. If you look at this chart, so this is the RevPAR, revenue per average unit. So this is, you can assume this is revenue because it is like utilization of the room and the room rate. So you can see that so far in the first quarter, you only had a 22% increase in RevPAR to $67. And you can see that pre-pandemic, this is almost as much as $150. So we still think that there's lots of room for recovery for Ascott Residence Trust. The yield is attractive, number one. Number two, as there are still 3 stages to this recovery in global travel. Right now, the recovery is leisure. Second, we think will be more business travel, and third will be the reopening of China, which I have no idea when it will happen. But the other point to note is that what attracted us to Ascott Resident Trust is that they still have, I think, around 200 million in reserves to pay out as dividends. So all this came about because of the disposal. So because most of their assets are located, right now they got more than 100 assets. Most of the assets are located in urban areas, and they managed to sell some at 40-50% above valuations. So that's the other attraction for this stock. There's a lot of hidden asset value because whoever buys their assets, because most of them are well located, use it for property development purposes. Next slide. So for Del Monte, Del Monte is a mainly canned fruits and veggie in US and Philippines. We like it because firstly it's 5 times PE, so most consumer names trade around 20 times PE, and of course there's also a dividend yield of 6%. But why the valuation is so cheap is part of the reason is because of the leverage. Just to dial you back again, they acquired the Del Monte US operations, I think 4 years ago or 5 years ago, and it took on a lot of debt to do this. And so as a result of that, it took time for them to deleverage. So the main highlight for Del Monte, where fourth quarter, the earnings was up 38%, is all about the US operations. So US used to be loss-making, but right now managed to turn around, and Del Monte managed to generate almost 100 million of net profit. So one of the reasons why the US is doing well is based on the picture here. So when they acquired Del Monte US, they sold off a lot of factories, shut down a lot because Del Monte was mainly focused on, for instance, selling to Walmart, and Walmart would just use their own brand. Del Monte was more like a manufacturer than a brand owner. So since the new management took over the last 3 years, what they did is, from this picture, there was more innovation. So they used to be only selling canned vegetables. I think it's probably the one on the far right, the bottom. Then they started to add more products like fruit cups, and they also added more like pies, veggie pies. So innovation has grown, and there's almost like 5% of the revenue. The other thing, what's happening, the revenue is also price increases. So they've taken, I think, at least 3 rounds of price increase, but very incrementally. And they plan to do more this year to offset the high increase in materials. So this is very important because for inflation, the one way to hedge it is to have a brand name. So they managed to raise that. Another thing is new channels. In the past, they were more like a manufacturer, that's producing, for example, Walmart or Costco, canned fruits. So right now they managed to move into food sector, like more fast food chains and so forth. And the fourth reason is because there's been a trend now because of food inflation. US consumers are shifting more to dining at home, and they were more willing to spend premium products. For Philippines, because of food inflation, they are affected. So we expect revenue to be weak in Philippines. One of it, the sector that's most hurt will be the canned mixed fruit, because that's more like a bit more discretionary. But the dominance is Philippines. Philippines are very dominant. They're very dominant in Philippines. So you can look at the market share, 93, 85. So basically, when you go to the shelves, there's basically no competitors, or maybe they're at the bottom rung, somewhere hidden, because most of the shelf is all filled with their products. But that's the strength, just that the macro is weak, and it will probably take a bit of time for Philippines to recover because of that. You need a better macro environment. Next slide. The next one is ComfortDelGro. I think I've mentioned this probably a few hundred times, but anyway, for us, we still like ComfortDelGro. Right now, finally we see the rebound in rail traffic. So for the month of May, you see that traffic is up almost 60%. This is probably the first month you see the year-on-year recovery. We will also see the recovery in in taxis, but taxis won't be the volume. So taxis will be more removal, lower rental rebates. And also for taxis, they actually will, because now they're going to charge for the app, so you're going to get some revenue from them. So that's the other way to grow. And the third reason why we like it was mainly because the balance sheet, very rare, but the balance sheet kind of strengthened in the pandemic. So they were like net debt, and then now they are on net cash, I think around almost 300 million. So we just need a bit of time for the recovery in volumes. And there's also operating leverage, because like you see this chart, when traffic numbers improve, all the revenue just drops straight to the bottom line, because this is a high fixed cost business. So whether you carry 900,000 or 600,000, more or less the same cost. Next slide. Next one will be HRNet. We like it because very rare you get a recruitment agency with such a scale, got 700 recruiters. The benefit of this scale is that with scale, you get the better pricing, and also the bigger customers for recruitment will approach you, and then you can cross-reference regionally. The second part of the business is flexible hiring. That strength is mainly because of the strong balance sheet. They got 300 million cash. And then for flexible hiring, that means you hire 10 workers. You need to pay upfront, so not many can have a 300 million net cash balance sheet to compete. The third thing is the business model. So the business model is asset-light, only 2 million fixed assets to make 60 million profit. And you can see from the table here, they generate a lot of cash. Some of it is pre-IPO. So it's a very high cash generative, very little capital required. So every year, this company will just generate a lot of cash. Next slide. Next, the one that we added is Singtel. So for Singtel, so this chart is basically the EBITDA for Singapore, Australia, and then for associates, which is mainly India. So we think there's going to be a rebound for Singapore and Australia because of roaming. Roaming is maybe 20% of revenue for Singapore and probably 30% of profits. And then we think that for emerging markets, because emerging markets are mainly prepaid markets, so we think the improvement in economies will also help in more discretionary spending, because prepaid is a bit more discretionary rather than in Singapore, where it's all fixed plan. Every month you have to pay what. For emerging markets, is when your incomes are higher, then you tend to spend more on mobile. So that will help them in the Thailand, Philippines, and also India. Then one last thing to note is India has become from maybe 10 players a couple of years ago to right now, effectively only 2 players. There's a third player, but that third player has a very weak balance sheet. So that duopoly has kind of made competition less fierce, and this was one of the benefits for that's happening in India. Next slide. So I'll just run through our weekly. So for some of the key macro news that came out over the past 1 week, if you look at Singapore, was the MAS announcement. So they're going to recenter the midpoint, basically going to gap up the appreciation of the Sing dollar. One of the reasons is because core inflation is climbing faster than expected. So right now, this year is one of the most aggressive moves that we've seen by the MAS. So in January, they raised the rate of appreciation. I know these are all big words, but this is how the MAS message, rate of appreciation, recenter, the bandwidth. So the second thing they did in April was to recenter upwards. The other, we'll talk about it more later on in the chart. For tourism remains very strong. We get a big rebound in Singapore. It's up 50 times, but it is only 1/3 of pre-pandemic. One big part that we're missing is the Chinese tourists. So Chinese tourists was almost 20% of all arrivals. Right now it's only 2%. So we're only getting like 1/10 of the normal traffic. Another data point that we got was ready-mix concrete. So this is more a pan-United thing. There's a bit slower right now. I think this year is only up 3% in terms of volume. We got some numbers from residential. For new launches, is down 44% in June. New private residential launches. So this is probably bad news for the property agents. Prices may be up, but the volume is down sharply. So for second quarter, it's down almost 40%. So we expect quite big numbers from the property agents. So for the first half, the number of units sold, new launches was only down 34 to 4.3 thousand. So on an average year, Singapore, we normally sell about 10,000 units for private residential. Last year was very good, 13,000, and this year we're probably ranging 8 to 9,000 roughly. So you're going to see that big 30-40% drop. In the US, some core numbers, I think we all saw the headline inflation. It was a 40-year high at 9%. For the core inflation, it is lower year on year. You can see it's 0.59 last month, but the problem is month on month is still rising. So we don't think inflation is going to slow at least to the next 2 to 3 months until you see this month on month number start to slow down. Retail sales in the US is very strong. So consumer spending is still very, very robust in the US. It is up about 10%. Just to give you some flavor, pre-pandemic, retail sales in the US probably around 4%. So right now, retail sales in the US is double the pre-pandemic levels. And of course, some will argue because there's inflation, but regardless, you're still spending money on, regardless if it's because of inflation. So it's still very robust spending. Some commentary by the FOMC, there are lots of it, but one of them is FOMC by Waller. So what he's saying is that in terms of 100 basis point hike, I think if they see data getting stronger, which it is, I think retail sales are really strong. So the next one to wait is housing data, that they might have to lean towards a larger hike. So in terms of our tactical views, quite surprised. I think there's some resilience building up in the equity market, because even though inflation was so high, beat expectations, but the market reacted quite mutedly. And also one of the things is that if commodity prices continue to roll over, I think that will carry some tailwind for the equity market, because it only means that inflation is very high, likely to have already peaked, and probably might see the numbers start to wind down in the later part of this year. We think 100 basis point high, I mean, this is a mute point now, 75, 100, but we think the 100 basis point is probable in the 26th July Fed meeting, because number one, the data is still good, because the retail sales is better than expected, and if the housing data, housing starts come out, which you can see on the bottom on the 19th July tomorrow, is better than expected, then we think his 100 basis point is very likely. Another reason why we think they could do a 100 basis point hike is because you're going to have to wait for almost 2 more months before the September meeting to do another rate hike. So from here to now, there could be, again, even stronger inflation numbers. So rather than have to go and do 200, I'm not sure, in September, they might want to just do 100 just to play it safe, so that they can hit their neutral rate about 3.5% probably as soon as possible. Because of all these aggressive rate hikes, I think Singapore banks will still be the winner. We've already seen in the second quarter, quarter-on-quarter, 84 basis point, which is 0.84% interest, almost 1 percentage point improvement rise in interest rates in Singapore. So we think you will get to see, at least in the second quarter, some very strong NIM expansion by the banks. It has to be, because it's already quarter-on-quarter such a big jump. Then you will see third quarter even stronger NIM. So we're going to get this big tailwind from the banks in terms of NIM expansion. And the good thing about NIM expansion is that you will just drop down to the bottom line when deposit rates are higher, because they got so much excess liquidity. The big uncertainty now is probably going to make the market a bit nervous right now is the Nord Stream until 21st July. Of course, not sure why they have to wait until now for Russia to cut the gas. So Nord Stream, just as a refresh, is the gas pipeline from Russia, especially to Germany. So if there's a total shutdown, the impact, I mean, depending on what study you want to use, there's all kinds of studies, but the impact to the German economy is -3 to -6 GDP. So you can assume Europe and especially Germany will just plunge into recession if they shut down the Nord Stream 1, because there's basically no gas to do any industrial production. They're basically manufacturing, everything has to shut down because there's no energy to do it. So that's one thing, I guess the market's a bit nervous and probably might be a bit holding back because it's a bit unknown. Only one person will know whether Russia will cut gas completely. The events are here for next week. So on the 18th, today we got Goldman Sachs. A lot of the US banks will release results. On the 21st, we have MLT. Thursday, we have Mapletree Logistics, and Friday, we have SETS results coming up. In terms of the webinar, excuse the US strategy already done, but we got quite a lot of webinars because it was blackout period in July, then in August, all of them come back on. So the most latest one will be this month end. Next week, we will have Capital DC read, and then we have SETS coming up and so forth. So if you have the time, feel free to sign on. We also have a US Marathon Digital on the 16th. Next slide. Okay, this is just an illustration of the rebound. You can see that the number of tourists that come to Singapore is 500,000. It's a big jump over 10,000. Basically, nobody came last year. So, of course, it's a big jump, but we are probably 1/3 of pre-pandemic, 1.5 million visitors that come to Singapore. So, hopefully this comes back and there will be a big boost to the Singapore economy. Even if it stays at 500,000, it's still a big boost compared to last year. I mean, basically nobody came to Singapore last year. Then the RMC, surprisingly, a V-shape, but it's more or less back to pre-pandemic and it's just stabilizing. This is RMC demand, ready-mix concrete demand. Next slide. Okay, this is the complicated chart, sorry, but basically this is the, how you read this chart is the blue line is the nominal exchange rate. So this is Singapore dollar against the basket. So Singapore dollar against Malaysian ringgit, and so no RMB, whoever we trade with. So you can see that the MAS policy is always to strengthen the nominal, the trade weighted, that means against a basket of currency. The red line is US dollar. If the red line goes up, means US dollar is we are stronger against the US dollar. So the main point here is, I know very confusing, sorry for that, but you very rare you get this blue bar, that means recenter. Recenter means very aggressive move. That means the Sing dollar, the MAS is I want to strengthen the Sing dollar immediately, so you recenter outwards. So we now had done it since the last 10 years, so we're getting it now. So in terms of the appreciation against the basket, in any normal year, because the MAS normal policy is increase slightly the rate of appreciation. That means we need to strengthen Sing dollar every year. So on average, this is about maybe 1.6%. So you can see in the number here. It doesn't mean we strengthen against US dollar, but against the basket we strengthen. So now that we are going into 5 to 6, the last time they did it, the basket, I mean the NEER probably was up about 5 to 6%. So you can assume probably the Sing dollar will appreciate an additional 3 to 4%. Again, this is just for illustration. The impact to the stock market are really not clear because there's really minimal impact to the stock market. But again, this is just for your understanding. If whenever they mention this is almost much ado about nothing. Probably might be more impactful for the electronic exporters, but electronic exporters are more important for them is US dollar. So this one is, I don't know, maybe you're going to Malaysia for some holiday, may be more impactful, and probably might impact some of the electronic manufacturers that are in Malaysia, because then the wages in Malaysia will be a bit cheaper. But again, not very meaningful impact for the stock market. But again, just for everyone's information. The next slide. Okay, this one is just an illustration of the inflation in the US. You can see it's a 40-year high. I didn't go all the way to 1980, but it's back to 1980. It started to decline a bit, so it's a bit of positive news, the blue line on the left. But the problem is the beige line. So this month on month, the thing to know whether it is really declining is that the month on month start to weaken a bit. Then you know that there is some decline. Then I think when this beige line start to drop, that's when I think the market will react more positively. Right now, you can still say that the inflation is still spreading, because core inflation means it's excluding fuel and excluding fuel and excluding food. A lot of it is rental actually. So you can assume that inflation is still spreading in the US. It's not still a bit early to say it will come off, maybe year end, hopefully. This one is the US in retail sales. It's just to show how vibrant retail sales it is in the US. So you can see that 2018, you're probably trending probably 4%. Right now it's 10%. So even though no more fiscal spending, but the US consumer is still very strong because there's a lot of ample growth, and wage growth in the US about 5%. So consumer spending is still very robust. Next slide. Okay, I'll just run through three Phillip on the ground. Again, the purpose of this is not to recommend the stock, it's just to give everyone, those who are not able or not allowed to join these meetings, we just want to share with you what are some of the key points that we got from the meeting. So just bear with us. I think some of it may not interest you, but just for information purpose. So Phillip Fortress Mineral is an iron ore producer, one of two. The profit was down 42% because ASP, which is the selling price, was down. You can see on the table on the right, it was 143 a year ago, then dropped. So obviously, when prices drop, all this dropped down to the bottom line. Not only that, if you look at the bottom here, the cost also went up from 25 to 32. So we'll explain later a little bit. So the main highlight for Fortress is their new mine, Mengapore, which they acquired in April 21. If you want to know the location at the bottom, you can see the map is somewhere in Pahang. So the amazing thing was that they acquired in April, and then in probably 8 months, it's already starting production. So it's quite a very commendable thing that they did. Right now, the production can actually double the group production, which is about 40 to 50,000. And there's also copper potential for this mine. One of the reasons why they're able to do is, like mentioned here, because of the low strip ratio. Strip ratio, for those who don't know, is that like you dig 4 tons of ore, that means you dig 4 tons of earth to get 1 ton of iron ore. So that means the strip is 4 times. That means how much work you have to do. You've got to dig so much to go and get the iron ore, more layman things. But the good thing about this mine in Mongapore was that it's easy to extract because most of the iron ore is on the ground, it's on the soil. Whereas if you go to their original mine, Bukit Bersih, a lot of it was boulders. So they actually use a lot of explosives there. They have to blow up these big boulders, big rocks, because they have to eventually make it into powder form. But for this one, it's basically on the floor. You can just pick up a shovel and just shovel it so you can get the iron ore. So they're going to get this windfall for the next 3 to 4 years because they don't have to crush anything, just have to crush it a little bit and it becomes sand form because they're all in like pebble form and so forth. So this will benefit in terms of the cost too. In terms of running a mine, for those who want to know, there is an increase in cost because they use a lot of diesel. So diesel price has doubled. Diesel is used in excavator because you got to dig up all the rocks, and also for the trucks because you got to truck all this iron ore to all the steel mills which is nearby. Electricity is very cheap for them because for some reason in Malaysia, electricity for miners is subsidized. Anyway, of course, the other cost is chemical. The two customers, so for an iron ore producer in Malaysia, you don't have to worry about customers because there are, I think, 3 to 4 big mills in Malaysia, all new mills set up by Chinese. And all you have to do is just send to them because they are much cheaper than if you go and import the ore from Australia and so forth. Okay, they do very little export to China, mainly just for a relationship purpose. So for the outlook for this company is that, again, barring the trajectory of iron ore price, because it's very, very difficult to predict, but at least for their production, you can expect production to double because of Mongapore, and also you can expect cost to be very low because, like I said, this is just soil. You don't have to blow up any mine to get the iron ore, just have to dig from the soil. So it's going to be very low production. So production-wise and cost-wise, it looks positive, but again, it's all the share price essentially still move according to the iron ore price, but at least for production and cost, it's going to be very low. Yeah. Next slide. Okay, don't worry, sorry, we're going to end soon. This is the last 2 slides. So for Oxley, Oxley also did a results presentation. I'm not sure why there was actually no results. They did one before because the last results was in December. So this is just more like an update. So Oxley, for those who are not familiar, is a property developer. They develop property in Singapore, UK, Ireland, and also in Malaysia, and they have some hotel investments. So what they wanted to share was that they have unbilled revenue of 1.7 billion. So unbilled means they've already sold the property, it just went to recognize because you do it progressively. You sell, you complete 10% of your work, then you bill your customer 10% and so forth. So on the chart on the right, you can see that the unbilled revenue at the beige part here is 1,767. So that's 1.7 billion. Most of it is Singapore. So they've already sold almost 1.5 billion of projects in Singapore, and you just have to wait. I mean, just have to TOP, slowly sell. So I mean, slowly build, and then you can build progressively. That means, I think most of us, if you're a property buyer, you know, every couple of months you got to, the banks will have to pay for your construction done. The problem for them is the unsold GDV. So unsold GDV means gross development value, means the unsold amount of projects. Basically, this is like inventory. You can call it they are stuck with this inventory in a way. I mean, to be brutally honest, this is really inventory. So if you look at the Malaysia Oxley Tower, they've probably 715 unsold. They sold 100 million, but they are stuck with 700 million. So it's only 20% sold. The GDV is 900 million. So as a result of this is going to be the main problem for them is how to clear the Malaysian property. This one is in the Twin Towers. So for them, what they mentioned is they're waiting for overseas buyers. I'm not sure when they're coming, but at least they're waiting for that. And that will be the one to help clear. So this will be the main thing, the main focus for them. In Singapore, again, because they are a developer, wanted to get feedback what they think of the Singapore development market. So for them, land price is of course increasing, then construction costs also increasing, and also interest rates also increasing. So so for them, they're not going to buy any land until they get all the 1.5 billion that they sold return. Right now, if they bid for any land, because of the increasing cost of land, construction costs, they have to assume to make some decent margin, at least 2002 to 2004 for mass market. So any mass market, I guess OCR project, you need to sell it at 2.2 or 2.4 before you actually make any decent profit because of the increase in cost. Right now, what they see is there's limited supply and the supply cannot meet the demand, especially rising HDB prices and also rising salaries and upgraders and so forth. Developers are not going to sell cheap because he says that developers are well capitalized because they make so much money, right? So they are well capitalized. And if you launch anything now, you got 4 years to sell, so there's no reason to price lower. So you can so there's no rush for developer to quickly sell since they got 4 years now. But the worry is always that for residential demand, no demand can disappear. But again, this is their commentary. This one just for update. The TOP means what they're going to complete. I'm going to go through that. In terms of the outlook for Oxley, they're going to focus more on developed markets, which is mainly Singapore and Ireland. So if you look at number 2 here in Red Island, so this is going to be their biggest project that they're going to launch, a 1.4 billion GDV project. The reason they're not going to go back into, I guess, countries like Cambodia or not so sure Malaysia, they're already there, so maybe they're stuck there. But it's just that the challenges of managing in emerging markets. So you got execution problem, you got problem with contractor, problem with authorities. Not say problem, but challenges, I guess. Whereas what they experience for developed markets like Singapore and UK is that even when there's uncertainty, the developed markets, the demand was still climbing. So in the emerging market, the local market will freeze. But for developed markets, they noticed that London and Singapore prices was climbing even during a pandemic. So that makes them more confident in developing in developed markets. And basically, these developed markets have stability during uncertainty. So that's why they're going to keep focusing on developed and not so much developing markets. Okay, let's next slide. Sorry, this is my last one. Okay, just on SPH REIT. We always like to brief on SPH REIT because you get a good sense of the retail conditions in Singapore. So SPH REIT is a retail REIT in Australia and Singapore. If you look on the table on the right, most of it, half of it all comes from Paragon. The next one will be Clementi Mall. So they raised their dividend. So right now they raised their third quarter dividend 5%, and the dividend yield now for this stock is about 6%. In terms of, because Paragon is mainly luxury, what they said was that inflation will be less impactful for high-end shoppers. Paragon 20-30% target market is tourism, and the next upside they hope is from Chinese travel. In terms of the new shareholder, of which is of course SPH new shareholder, the new sponsor is property based, so it's early days, but they don't expect any major change in the strategy. In terms of the rental, the leasing sentiment has improved, and tenants are more willing to accept higher rents. Basically, the tenants are not going to negotiate. I think they see the recovery, so the sentiment is improved with the tenants. In terms of the growth, so during COVID, what they did was, the key was to maintain occupancy. So the most important for them was just to make the mall filled. So they managed to keep the mall filled at 97% occupancy. So right now the growth is, the big one is NTUC. So NTUC is going to, because NTUC own the malls under the name Mercatus, and there's 4 malls being bidded out. You can see here Jurong Point next. I think most of us will know these malls. So this will be the big one. Of course, I'm not sure who's going to win it, but this is up for bidding right now. I'm not sure who can win, but anyway, this is the one. They also have 2 more ROFR assets that can come from SPH, which is Seletar and Woodleigh Mall. So the outlook is that for us, at least, we think there's more upside from Orchard malls than suburban malls, because we think for Paragon, at least they had 2 rounds of totaling 15% decline in rental reversion. So at least we know that for Orchard malls, there's clearer upside growth because they just have to go back to pre-pandemic. There's some growth there. Yeah. Okay. I think that's it. I think we won't run through too long because it's quite long. Yeah. Thanks, everyone. I think we can move on to questions.
Sorry. Yeah. Hi. So I'll take the question I have about Silver Lake. Let me see, where is it? Yeah. So hi Glenn, is Silver Lake Axis still a buy since it's already exceeded your target price of 38 cents? If yes, can you share with us what is the latest target price? Thanks. Yeah, it's still a buy. We are currently reviewing our target price, so I mean, do keep a lookout for that. So I can't share anything now. Apologies, but maybe I'll just speak a bit about Silver Lake since I'm on the topic. So for those who don't know, Silver Lake, they provide customized software solutions and core banking systems. So it provides the digital economy software solutions and services in the banking, insurance, payment, retail, and logistics industries. So why we like Silver Lake? I'll just very briefly talk about it. Because in 2020, although we can see that the banks were quite conservative, with the COVID and the pandemic, they were very conservative with their IT spend. We can actually see that they grew their maintenance and enhancement revenue. So this revenue is their recurring revenue. So even though their total revenue fell in 2020, their recurring revenue grew. And actually this maintenance and enhancement revenue has the highest margins. So they have to go back to Silver Lake. The companies that have their core banking systems have to go back to Silver Lake for any enhancements. So even with the downturn, they still managed to sustain their revenue. So now, I would expect them to be able to sustain their revenue as well as grow their maintenance and enhancement revenue further as the bank spending will increase. And secondly, would also be their new product, which is the Mobius banking platform. So this is a cloud banking software, and it allows the banks to roll over new digital products, so in a very targeted and timely manner. And one of the good things about this platform is that it can coexist with existing core banking software. So it doesn't need to be Silver Lake's core banking software. So other brands, they can coexist with them. Yep, and Silver Lake has also recently signed a deal with one of the largest banks in Thailand for this Mobius banking platform, and they also expect to see increasing inquiries in the region. So I hope I answered the question regarding Silver Lake. Let me just briefly go through. Okay, I think the rest of the questions are for the rest of my colleagues. I'll hand it over.
Yeah, sure, Glenn. I'll take the rest of the questions in the queue. Keppel Corp, your views on its recent downtrend, what will happen if the KOM and SMM does not materialize on Keppel Corp share price? So the recent downtrend is in line with the sell down in the overall market. The SCI it has sold off very sharply because of the quantitative tightening in the US also, and so that's one reason why it's come down. The second reason for the weakness in Keppel Corp's share price is also because of its exposure in the Chinese property market. The Chinese property market is seeing a little bit of headwinds now because of regulatory clampdowns, and so that has put a drag on its property portfolio. Your second question, what will happen if the deal does not fall through on what will happen to the share price? Our current share price on Keppel Corp, which is $7.07, does not take into account the deal completion. So there'll be no change to our share price if the deal does not take place, because there's still a lot of hurdles they need to clear before they can consummate the deal. So because of all these hurdles, we have not incorporated this accretion into our EPS, our EPS, and also our share price. So if all things equal, there will not be any change to its share price, but we could see some upside because the KOM business, because of the higher oil prices, they have also seen an increase in order flows. So that could have a positive impact if the deal doesn't go through. Terence, interesting sharing about city developments on its potential upside. Does the same can be said for Hobby too? What about PropNext, who is also part of this value chain? So Paul covers PropNext. I'll probably let Paul take the second part of the question. But can the same be said for Hobby too? So the answer is yes, because again, the lack of supply in the market and then the very high demand for property in the market will benefit developers like city developments, but we are more bullish on city developments because it's the largest property developer in Singapore. So we believe that they will benefit more from the overall lift in demand and prices as well. I'll probably keep this question here for Paul. Let me see if there's another one for you. You mentioned pre-ready concrete demand has now gone back to its pre-pandemic level. Appreciate your comments on Pan United for the next 6 months. Yeah, so I think Paul mentioned that a pre-ready concrete demand has already gone back to its pre-pandemic levels. For the next 6 months, we continue to be bullish on Pan United. And one of the reasons why we are bullish on Pan United is because the construction demand, the first reason is because construction demand for the BCA it continues to be very elevated. They expect about $30 billion, $29 to $32 billion in contracts for this year. The second reason is the ramp up in BTO supply in 2022 and 2023. So at the end of 2021, to cope with the rising demand for housing, HDB actually announced that they'll be ramping up their BTO supply by 35%. To cope with this rising demand for property. So they're increasing the band from about 21,000 flats launched every year to about 23,000 flats for the next 2 years. So we believe that with this ramp up in supply of HDB flats, this will have a positive uplift for Pan United. I don't know if Paul have anything to add, so I'll probably leave this question here as well. If I remember correctly, Phillip is bullish on Silver Lake and BRC Asia. May I ask why are they not included in the absolute 10 portfolio? So the absolute 10 portfolio takes into account some of the most of our top picks, but we choose the top 10 that we think we are most bullish on, and then we have to take into account the risk and return as well. But I'll probably let Paul take this question also. Yeah, I think that's all from me. I'll hand over the time to the rest of my team.
Yeah, thanks. Just on the absolute 10, we try not to introduce too small market cap because it's meant to be a portfolio. I mean, ideally meant to be a portfolio, so we don't want to move it too much, and it has to be a blend because it's supposed to be a pseudo portfolio, so it has to be some with dividend yield, not like you typically would have in a portfolio. Don't put all the all the like high growth stocks. So that's something that we are very mindful of. We only put in a mid cap name if we are very sure of it. Otherwise, mid cap, small caps are very volatile. Yeah. So it's supposed to simulate, again, just for illustration, it's supposed to simulate a portfolio with a good blend of yield. Although of course we don't take dividend yield when we compute this for performance for illustration, but that's the main purpose. It's mainly just to have a balance, so that we cannot just put everything growth and because this one there's a lot of transparency and accountability to it. So if the thing don't perform or lose money, you're not going to get like 50 questions every day, like why you choose the stock so badly. So we are a bit more careful of it. But the difference is that we just want to just want to make it clear that we don't want to, it's easy to just put a stock out there and then after 3 months then don't talk about it, right? So for us, this one is a lot to do with transparency, so that once we tell you a name, we are stuck with it and we have to account for it, not just like go on the newspaper and say, oh, we like this stock, that stock, then 1 or 2 months later then forget about it, because those who follow, we have to be accountable for it. Yeah. Okay, Darren, you want to help out on the MCT if you are ready, or?
Yeah, hi, Paul. Also for MCT, the question is, what is the rationale of MCT's offer of new units to shareholders priced at $2.39 per unit when the current market purchase price is around $1.80 per unit? First of all, because of the merger, MCT overall will have the new merged entity will have a bigger market cap and will leapfrog to Asia's top 10 largest REITs. And then because of that, they will also likely have a bigger float. Of course, that's depending on the option of the payout of the NPACT, like whether more people will choose a cash option or whether they will choose scrip. And then also because of cost synergies, for NPACT, for MCT and MNEC, right, Right now they need like 2 CEOs and management, but then with the merged entity, they only need 1. So there are some cost synergies there. And then
So the preferential offer is $2, is it?
$2.0039
okay.
per unit.
Yeah, I think like Darren, there was an email before. So just to explain, I mean, who wants to take out a preferential offer at 2009 when the share price 180? Like take out a placement to lose money. So the only reason is because, correct me if I'm wrong, Darren, because to make the offer attractive, so that because they have to pay cash to the cash offer to the MNet shareholders, the Mapletree North Asia shareholders, the parent Mapletree had to come in and give the shares. Otherwise, I mean, you think one who wants to do a placement to lose money, right? So the only one who will do it is the parent, because they had to make the deal go through. They had to give a cash offer to the Mapletree North Asia clients. So that's why you see this lose money placement. Like nobody in the world want to do this. Is that right, Darren? Is that one?
Yeah, correct.
Okay.
There's also another question. Hi, NNet shares has been freezed for quite some time. Can you share when the payment in cash is? So the date is 29 July. That's the date that the payment of cash will be done for MNet.
Oh, okay, thanks so much, Darren. Yeah, thanks for the question. Let me just move on to the next one. Paul, HRNet, why the share buyback doesn't seem to move the stock price, or could there be other reasons that these counters seem to be not appealing to big boys? The only thing I would say is maybe the liquidity is not appealing to them. For me, I don't really. Yeah, for this particular stock, you just I don't. My own thoughts is just have to buy it and then just keep on collecting the 5% yield as you wait for I don't know, maybe the market to kind of recognize it better and the results to come out. So at least number one, you're paid, I think, around 5% dividend yield to wait. And not to keep on talking about this, but not many companies you see keep on generating cash and you don't need to inject any capital. So this one will just keep on spurning out cash and you just have to wait and let the economics of the business run. That's as most as we can do. Again, stock market is like a social game and strangers have to kind of agree with your view. So that's the only, I know it sounds a bit weird kind of answer, but that's the only thing I can say. We just have to wait. We have to wait for the share price to hopefully recover, and hopefully when the results come out, they can show it that way. Yeah. So for me, we got no issues because the comfort is that they keep on generating cash and don't see any change to it. Yeah. And maybe when the results are out, we try and get them back again for a webinar and hopefully can address this question. Because again, even the management is quite puzzled about the share price. Ambrish, you want to take on the next one?
Yeah, sure, Paul. So there was one question on Airbnb. What's its net debt position and how it compares with respect to bookings and Expedia? So as of December 2021, Airbnb, it has a debt of about $2 billion, whereas it has a cash position of $6 billion, which means basically that it has a net cash position of $4 billion. In comparison to bookings and Expedia, Booking has a net cash position of about $226 million, whereas Expedia has a net debt position of $2.6 billion. Over to you, Paul. Thank you.
Okay, thanks. Let's move on. What are your views? Hi, Paul. What are your views on Genting generally? So for Genting, we don't cover, but I guess one way to benchmark the share price is that pre-pandemic, the share price was around 90 plus cents. So I guess, I mean, theoretically, of course, you don't have the Chinese visitors. Theoretically, it should kind of move back to those levels, back to the pre-pandemic. I'm assuming the crowd comes back and so forth. But as highlighted many times, there's no growth. There's no more growth in Genting Singapore. So just be mindful of that. But because most of the young don't gamble, most of them go online. The weird thing is that there's an inverse relationship between gaming and your age. the younger you are, you do more online gaming. It's only those very old that will go for physical gambling, like slot machines. So there's an inverse relationship between the type of games you play and the type of gambling and your age. But the good thing is that we think Genting, in the last briefing that was a couple of months ago, they did hint that they are going to be a bit more specific on the dividends. So we won't be surprised in the next results, they might be a bit more generous in dividends, because Genting has never been generous in paying any dividends. But this time around, I think because there's no more Japan opportunity and they're holding on to so much cash, we can look out for that. Yeah. In terms of the takeover offer, in a way, it's not for shareholders to agree. I think the authorities also have to agree, because once you take over, you are basically giving away the license. There'll be a new license owner. So it's a bit more complicated, because it's not just shareholders. The authorities have to approve this thing because of the licensing. Okay. Let me try to move on to the next one. Comfort Delgo, how did they move from net debt to net cash in the pandemic? Okay, part of it was because in this business there is a lot of depreciation. So even though revenue is down, there's still a lot. They still manage to generate operating cash flow. Number one, there's also government subsidies. So thanks a lot. There's also they wind down a lot of the capex. I think about 200 million. Around 200 million, I mean, roughly, for the last 2 years. So that's the reason how they managed to, they gone back to wind down so much of their debt. I mean, you can check it out yourself. I mean, they were slightly net debt, and in the last 2 years, there was a windfall in terms of cash for Comfort Delgro. Okay, for Del Monte, how much is their debt and leverage now? Did they pay down the debt, and by how much? Okay, I'm give me a minute here, but their debt is about about a billion, 1.5 billion. So that is what scares investors. But what we see is that because of the turnaround, they made like 60 million in FY21, then 100 million in FY22, and they generated a lot of cash flow. So that's how they managed to not only pay down some of the debt, more important is to refinance a lot of the debt. So they got one expensive, I think 200, if I'm not mistaken, I think it's 200 million US. Forgive me if it's a wrong number, but that was a high cost debt. It's about 12% interest rate. So that for that, they actually refinance it downwards to 6%. And also they managed to get a rating agency to upgrade the debt. So that was the deleveraging. So one of the drivers for FY23, because theirs is April year end, is that by refinancing, the interest will come down, and also the preferential shares dividend will also come down. Then there will also be another kicker to their earnings growth for FY23. So that is the hidden growth driver for them, because they refinance, they managed to bring down the cost of debt. Okay, there's a lot of questions here. Paul, any views on counters for coal and palm oil, with Europe likely to be affected? Russian-Ukraine war dragging into winters, or the high, or dragging into winter, or the highs of these counters are over? I think for palm oil, again, we don't cover, but just my own 5-cent view is that for palm oil, I think maybe the better way to play may be through Wilmar for palm oil. For coal, I think Golden Energy is the one that we like, and I do agree. I think coal has still room to run, because the reliance by Europe on coal will continue. I think it's just the conflict only started, I think, in March, right? Okay, there will only be a couple of months that they started importing coal. So I think coal is still has room to run, especially like you said, if they drag this into winter, because their gas inventory is pretty low. Yeah. So I don't have a very good answer to that, but just off the top of my head, sorry for that. Paul, on Jaffa, any comments on why the stock price not moving? Is the company unable to pause pass the cost to consumers, which affects stock price. Yeah, and or any are there other reasons? Yeah, I do agree with you. I think the thing for Jaffa, most of the profits actually come from feed mill, which is they import corn and feed. And I think the ability to pass on to the poultry sellers, which have to pass it on to the consumers, will take some time. But you know, for Jaffa, it's always a very cyclical stock. The best time to buy is when the worst news, because it comes in a cycle. Poultry price or chicken price in Indonesia is like riding a roller coaster. I mean, if you look at the chicken price in Indonesia, it's a real roller coaster. So so the best is always to buy when the news is the worst, the headline is the worst. Yeah, this is my experience with Jaffa since it got listed. So the best time is not when the news is all great, that's the worst time to buy a Jaffa stock. Because eventually when the chicken price is high, there'll be a lot of supply coming in, then they'll collapse back again. Then they have to regretfully cull the chicken, and then they'll bounce back again. So this is a cycle that's happened, I don't know, for the last couple of decades. Yeah. Paul, the US retail sales year-on-year figure is stronger, but has it adjusted for inflation? Oh no, these are all nominal numbers. So the inflation numbers that they give is just pure nominal. It's not adjusted for inflation. Hi team, what's your take on Wilmar? So our general take for Wilmar is positive. I think because they raised prices in China, the cooking oil under the Yihai, Kerry, Arana, Disco. So I think if you look at that, the share price for that, it started to bounce. So that will give you an indication that they've managed to. So number one, their cooking oil division will recover because they raised price. Number two, their palm oil processing should also improve because oil price is down. So when the palm oil price is down and there's oversupply of palm oil, it benefits processors like them. Number three, biodiesel will also improve because of the high oil price. And then number four, the soy crushing should also improve because the hog prices is recovering in China. So for them, just as a refresh, they will buy the soybean from, I don't know, maybe US or Brazil. They will crush it into meal and then they'll sell it to the hog farmers. So how much you can pass it on to the hog farmers depends how well the hog prices are. So hog prices are recovering in China, so that is helping them. Again, I don't cover, but this is just a general, our own general view. How is the China situation affecting HLNet? Do you think it's being overhang on the stock? That could be a possibility because Shanghai was shut down. But I think what is happening in China is that they're getting a lot more traction on the technology hiring. I think you might probably hear more of it in the briefing, but we think that hiring in China technology is done well. So they managed to placate that. But I do agree, maybe that could be some concern. But you know, China is probably 20% or so for the business. But you're right, that could be one concern. But from our understanding, we think China should be okay. Yeah. Because they are hiring manufacturing. There's a big hiring move in manufacturing in China, especially semiconductors and so forth. And that is something that they have a position in. Okay. Okay, let me just try to run through everything. Sorry, some of these questions are very wide, so we may not have a good understanding. Your view on Rex International, please. Share price has dropped considerably. I really have no view on Rex as a company. It's just I guess an all proxy. And if you look at some of the data for all, US production is starting to climb, and the inventories are starting to build again a bit in the US. So maybe there has been some supply response. Even the Russian has managed to, if you look at Russian exports to China for oil, it's up 50%. I think that was one that I don't have it. Maybe in the next week we will share. But so Russia has managed to sell a lot to China, so the exports are up 50%. So I think probably the market is just a bit worried that there has been some supply response to crude oil, and maybe that's why the oil price is coming down. We'll try and share a lot more of this data next week, because this week has been a lot. Hi, any view on Chip Eng Sing? Share price has been rising steadily in the past month. Apologies, we have no idea. They don't want to meet anyone, so we don't really have much of idea. But for us, like Terence mentioned, the unique thing for CDL is that they have a pipeline of very cheap inventory. So in the government redevelopment, CBD redevelopment plan, they're giving you free free plot ratio, basically giving you free residential units to sell. I mean, in a way, provided you top up some development charge. So their costs when they sell some of the projects that's coming up, it can be very low. It's so low that they don't want to disclose in a way. They never want to give us how much development charge they have to pay. So I think the unique thing for CDL, at least for Singapore property, is that they got a pipeline of very cheap inventory. Yeah. So that's one of the reasons why, as a beneficiary for rising property, they are one of the ones. The positive results for Del Monte did not move the stock price much. What potential stock catalysts do you see valuations to? I think it will be just strong earnings growth. Yeah. Frankly, the only broker that covers them is us. So you can see how little interest there is. So it will take time. And when you make 100 million US, I think eventually you're going to get a lot more coverage. Because this is US net profit 100 million, right? So I think the main thing when they start to delever more, then maybe more and more investors will be more comfortable. The other thing is that they are also looking of a US listing of the US operations. So the stock is 5 times. Obviously, they list in the US, anything more than 5 times is going to be a windfall. So hopefully they do some dividend in specie. I really no idea, but they are looking to list in the US. They wanted to list in Philippines, but that got cancelled because of market conditions. Code word, they couldn't get a very good valuation there. I think they're looking at maybe 20 times or something. Yeah, maybe they should have listed. The market drop after that. Yeah. Okay, just 2 last stocks. Please bear with us. Paul, hi Paul. On MM2, some reports about the liabilities are more than assets. Any comments? I think that was already known in the results a few months back. I think the key thing for me, although I don't have the answer, is the cinema is technically already sold. So how much debt is tied to the cinema, I'm not very clear. So do note that they can de-gear very fast. Once they sell off the cinema, and they will still keep a stake. Sell off means they will sell off more than 50%, so they don't have to consolidate. So the balance sheet won't have the debt of the cinema. And the second thing is unusual. I mean, if they do sell out unusual 100 million, they can also de-gear quite fast. So although it's very high now, but they have assets to sell if they want. It's just the amount of pricing. Last one, energy resource prices pulled back. What's the rate going forward? It's all about coal price. I think the whole commodity complex has corrected quite a bit. So, but we are still positive on coal for us, although we don't have official coverage. It's just that, like highlighted before, there's a new buyer from Europe. So that's the only thing we can say. Yeah, I think we took on most of the question. Oh, sorry, there was one question because I came in late. Paul, your views on those COVID recovery stocks such as Escort Trust Genting Singapore with uptrend of Omicron cases in Singapore since last week or so. Among these recovery team stocks, which one would you think have the resilience and momentum to have a good surprise in the market? Maybe Genting Singapore. I think they could give a dividend surprise. That could be one. And Escort too. I think for Escort, you just have to wait. Wait, because it's very obvious directionally. We can't give you a precise number when things will rebound back to pre-pandemic. But at least directionally, you know that Escort, Comfort Delgro and Genting, the recovery is just on track. You just have to wait on the next 1 to 2 years. And the big, I guess, the big catalyst is China in the headlines one day. China, I'm not sure when. Hopefully one day on the headlines, China say they're going to reopen and everyone can travel. Then all these stocks will gap up, especially Escort. All these things will just gap up immediately. But again, I do not know when. Probably only one guy in China knows when they'll reopen. But that's why we think, if China really announce, all these stocks will just suddenly there's a chance for all these stocks to surge. Okay, I hope we answered all the questions. I mean, not everything we can answer well because we can't know everything, but hopefully it will help everyone. So we'd like to thank everyone for your time and do sign up for some of our webinars, especially Keppel DC REIT on the 28th. And thanks for all your questions, and wish everyone to have a good week ahead. And thank you everyone for your participation. Bye-bye.